Well, let's take these excise taxes and apply them to the entire economy. Let's enlarge them and admit that corporate taxes, income taxes, payroll taxes on investment, on capital, and on labor also have excise effects. This is not the I've given you money to spend or I've taken it away kind of tax. This is what the heck did I do to these supply and demand curves and these tax wedges. This is microeconomics brought into the macro system. The labor supply curve is assumed to be fairly steep. If you're working for a company and it wants you there 40 hours a week, you don't have much leeway in setting your hours. They may even mandate you to come in sometime for overtime. You have no choice. If you're self-employed, you have more flexibility. If you're a married couple, then one of you may be fully employed and be the primary breadwinner. The other might be thinking about taking that second job for the household, or maybe not, depending on how valuable it is to go into work and bear all the costs of commuting and uniforms and dressing and transportation and so forth. And then also the tax involved, and see if the after-tax wage is worth it. And then, of course, you might get the teenagers wondering whether they should take a job mowing the lawn or delivering papers or what have you. So there are various groups in the population that have different elasticities, but in general, we find it somewhat steep. Now, international data suggests it's steeper than the domestic data suggests. If you look across Europe versus the United States, hours worked in Europe versus the taxes paid in Europe indicate quite a big difference from the United States. The domestic data show a little bit less difference. Measurement issues in supply curves are legion. It's hard to do, but we do seem to see a labor supply that is not vertical. How sloped it is another issue. We use 0.3 in our tax and economic model. And so when we measure the marginal tax rates on labor that determine that tax on that last unit of hours worked, and we have a labor supply curve, and we know the marginal product of labor, which I'll get into in a minute, we can calculate how much the quantity of hours worked will go down. And more sophisticated models break it down into labor force participation versus additional hours worked of people already in the labor force. That's a refinement. But the tax on labor, though, because the labor supply curve is steep, is mainly borne by the worker. How many of you have heard that the payroll tax is borne by labor, even though it's supposedly borne half by the employer and half by the employee? CBO will tell you that almost every time. This is why. Okay, next. Capital is different, all the way back to the Wealth of Nations and Adam Smith, and in detail in Alfred Marshall's 1890 textbook and all the 25 editions that followed it. If you put a tax on the printing press, the printer's going to bear the tax until the machine wears out and he buys his next printing press in the next county where the tax hasn't been imposed. Short run and long run. Who bears the tax? If it's immobile capital, the owner bears the tax, but if you wait long enough, it's mobile. And he had the whole thing written out. Taxes between counties in Britain, taxes between Britain and France, the whole theory of taxation in 1776. And it was largely the way people thought about things through the 1890s and the early 20th century, and the Depression wrecked it, and for 50 years nobody paid any attention to it. But this is modern theory again, the neoclassical recovery. Capital is mobile. All those inversions, capital is mobile. States competing for the Mercedes factory or the Volkswagen factory or the Toyota factory, capital is mobile. People who are thinking, do I buy a domestic mutual fund with US stocks, or do I buy a developing market mutual fund where the markets seem to be a little more ebullient and they have more room to catch up? Capital is mobile. If I want to buy an extra computer, how likely am I to go to the store and find that they're out of stock? Not likely. Even if they were out of stock, how long would it take a new shipment to come in? Not long. If you're willing to give me a little time to build out my factory and to order the parts, I can build a lot of factories, a lot of buildings, and buy a lot of computers without much effect on the price in the world. And if I don't have enough saving here that you're doing to borrow to build my factory, I'll borrow from somebody abroad. Trillions of dollars of capital flow across borders. So we have a net return, which seems to be about 3% in a world with courts and law and order, and not too risky. And that's a pretty flat supply curve of capital. So when you put a tax on that kind of situation, the capital stock has to shrink until the returns on the capital go up. What it can charge customers and users is pushed forward because the saver is not going to buy it. He's not going to do the saving. He insists on that return, and you find it raises the cost of capital, and that means less can be purchased, less can be used, and you get a big change in the capital stock. The labor supply moves a little bit, the capital stock moves a lot. Ramsey efficiency, if this is true, tax labor, don't tax capital. What do we do? What are the tax rate levels here in this country as between labor and capital? Even with the payroll tax, taxes on capital are higher than on labor. We'll see why next week. So kind of doing it backwards. When you tax capital and it shrinks, the product of labor falls because workers have fewer tools to work with. So the demand for labor falls and the wage and employment fall. The company or the saver, they're the ones writing the checks to the Treasury. That's the legal obligation to pay the tax. And the initial incidence of the tax is whoever you put it on, the owner of the printing press who hasn't been able to move it yet, he'll have to pay that tax. That's the initial incidence. And incidences and legal obligations to write checks are what you see in the burden tables. But once the capital has moved and the wages have adjusted, the economics of the tax suggests that it's the workforce that bears the tax, not the saver and not the investor. So the burden is different from the incidence and the legal requirement to pay. And so if we can measure these tax wedges, we can do a model of how much capital and labor you're going to get after a tax change. And if you look at your textbook, I know you don't want to do this diagram, but if you see those little white boxes with little supply and demand curves in those flows, most texts leave them out. Our text puts them in to remind you that if you put a tax there, you're going to shrink the flow. It's like a garden hose where you put a clamp on it and you've tightened it. Even if you use the revenue from the tax to increase government spending, the output of goods and services, the amount of capital and the amount of labor in the economy is going to stay shrunk. It's not enough to add to the demand. The tax has shrunk the quantities. And so you do not get this automatic multiplier or circular flow where if you take it out of the economy but spend it, you've put it back in, you're okay. That doesn't obtain if the markets tell you, uh-oh, we're not going to produce. So if you have less labor, L, and less capital, K, you're going to get less output, Y. That's a Cobb-Douglas production function. It's a very simple one. There are more elaborate ones that one can use. They don't lead necessarily different outcomes. I just want to point out it was invented by a senator, Paul Douglas from Illinois, who used to teach in Illinois. So anyway, there we go. So how much did the tax wedges move? How much did the factors respond? How much did they decide to change their habits about labor versus leisure? How much did they decide to change their habits about consumption versus saving or capital accumulation? That will give us a way of measuring the effect on the economy. That is not the same thing as C plus I plus G plus X minus M on that aggregate spending diagram. That is the macro approach, which regards the flows as coming first and the production coming second. This says the production is coming first and the output is sold, and then the income occurs. If you go into an economic growth text, or if you go to a business school course in corporate finance, you're going to see an equation something like this. It says that the required return, the output that you need if you're going to bother investing, is R, a real return that you want to have, that roughly 3%, plus the fact that the asset may be one of the sorts of things that wears out or becomes obsolete and has to be replaced, so you have to recover its cost. That's the R plus delta. Now, there are two adjustments we have to make. If these returns are being taxed, let's say there's a 50% tax, I have to earn twice as much because I have to give half of it away to the government. So I have in the denominator 1 minus T, 1 minus 0.5 is 0.5, and 0.5 in the denominator is the same thing as doubling the item. So that grosses up the return for the federal tax, and then I show the state tax, and then if it's the corporation with 2 layers of tax, I have the individual tax in addition to the corporate tax. That's in the denominator. It boosts the required return. But when I buy a machine, of course, if it does wear out, I have the right to count it as a cost of doing business, and I save my tax rate, TF, times the write-off allowed by the federal government, and TS, the tax rate at the state level, times the depreciation allowed at the state government, and I have to throw in an ITC in the upper part of that equation if an investment tax credit happens to be present that year, and the Z will change if there's bonus expensing, or if there isn't bonus expensing, or if you change the depreciation schedules. Anyway, there it is. That reduces the cost of the plant or the equipment. And when you put them all together, I know what I have to earn, that little y over on the left. And on the right, we have property taxes. And those are generally deductible at the business level, but not at the individual level for the shareholder. So that has to go over there, too. And if you invent new taxes, I have to add them to the equation. This is, of course, a bloody nuisance. And the Z's require you to know the whole history of the capital stock if you want to do historical data. You have to know what the capital was, what different tax rules applied at the time. You have to work through the whole thing. Most people don't bother. They do these trend lines and reverse, reduced form equations. Well, we've actually gone through the whole mess of it from the early 50s right up to the present, and we're in the process of relating the changes in the Y's to the changes in investment and capital formation going forward. And I think we're already finding good results. We're going to find that in fact, these things do matter. So when you're designing a tax bill, you need to look at TF, TS, TI, Z's, all these things that affect the tax base and the tax rates in order to determine what's going to happen to the economy when you pass the bill. Joint tax is only getting started with this so-called dynamic analysis. They're putting together new models, some of which now have some of this in it that didn't have them before, although very few of them have the detail on the capital stock that we have. Dale Jorgensen up at Harvard has a lot of detail as well. But this is something that is only possible in the last 10 or 15 years as the data has come to being and we've had the computing power to actually deal with it. The very old models back in the 60s and 70s had none of this. I showed you a fairly flat rate of return on capital in that graph where I was talking about the tax wedge. This is the real after-tax return to capital. That's the pre-tax nominal return up top. It spent over 80% of its time in the last, since the Kennedy tax cuts, about 85% of its time between 2.5% and 3.5%. It's pretty flat. And the economy keeps coming back to a return of roughly that magnitude. Fairly soon, within 5 or 7 years after a tax change has jolted the return away from its normal. So the capital stock seems to be adjusting within 5 to 10 years. Maybe within 5 years for equipment, 10 years for buildings. I've seen articles from Britain saying, oh, it takes 100 years for the building stock to generate a change, or oh, it takes 75 years for the capital to adjust in the United States because we have only this limited amount of savings, so we couldn't possibly change the capital stock that much. But historically, it's come to be in 5 to 10 years. So we're getting the saving from somewhere. Whether they know where or not doesn't matter. We used to know that blood left the heart through the arteries and came back through the veins, but until Leeuwenhoek invented the microscope, he couldn't see the capillaries. So the Greeks knew there was something going out and something coming in, but they didn't know what was pulling it together. So they have their anatomy text, but they don't have any capillaries in it. So of course, we're all dead. No, something real is going on there. We just didn't know what it was. When we need saving, the notion is, well, if we save more, we'll consume less, the economy won't grow. If we want to save more, we can take a second job or work longer hours. If we want to invest more in the United States, then some of the bank lending we're doing abroad can stay home. That's what happened in the early 80s. If we have a better investment climate, foreigners will bring in more cash. Or dividends will be cut, or something. We will get the saving. We always have. And it comes fast, which means the benefits of growth come quickly, not slowly.